This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This lecture is about alternative performance measures. There's no real definition of alternative performance measures. It's really just that companies sometimes present performance in slightly different ways. Here's the profit and loss account of Marks and Spencer's. And I say to you, what's the profit? So I look at these accounts and I look for profit. And I can see there are two profits. A big one, 418, and a little one, 58. Now, in fact, the one that is required by accounting standards is the total one, but Marks and Spencer's have chosen to exclude certain items, probably because they won't happen very often. So they're saying, well, actually the profit was 58, but if these one-off things hadn't happened, the profit would have been 418. What makes it confusing is that this seems to happen from year to year. In the previous year, their profit was 73, but it could have been 455. So the good news is that by looking at the profit before adjusting items, I guess investors would get a better picture of the ongoing results of Marks and Spencer's. And in fact, you can see, if I was comparing the two green numbers, there we go, the investor can actually say, well, they are not doing as well, which is true. They had a bad year. And if the company has integrity, I guess in presenting those performance measures, then that's a great thing to happen. Marks and Spencer's has integrity. Some companies don't. And therefore, they can start, adjusting for things that they don't want investors to know about. In addition, companies will sometimes, again, produce all sorts of alternative statistics. So I think right at the start of their annual report, Marks and Spencer's will present all sorts of information to investors. So let me just find some information. Things like customer footfall. So I guess that's how many people in the shop in the year. The average number of transactions. Again, all sorts of information. A comparison by segment, again, of how results are doing, what's better and what's worse. I can see on here as well something about whether customers think that Marks and Spencer's gives them value for money. These are all alternative performance measures. And the problem, of course, is that there may be lack of consistency, and some companies, not this one, but some companies will seek to manipulate that information. One of the most significant alternative performance measures, coming back to your course notes, is this word EBITDA. And when we had the dot-com boom, a lot of dot-com companies were not making any profit, but they found they would make a profit if they started to add back some of their expenses. And obviously, if you had a business and you added back all of your expenses, that would be wonderful. You can't possibly make a loss. Now, the benchmark that is commonly used is this word EBITDA. EBITDA, you can see, you add back interest and tax, which most people can live with, but you also add back, again, depreciation and amortization. Why? Because companies would say these numbers are subjective. because they're subjective, let's miss them out. And that leads to confusion, of course, because many people think that EBITDA is the same as cash flow. It's not the same as cash flow, because cash flow also takes account of working capital. So EBITDA may help with comparability. That's a possibility. So it may assist with comparability, but it does lead to confusion because it's not cash flow. So if you want to know the money they've got, as you know, you look at the cash flow statement. Because of the existence of these measures, then regulators need to sort themselves out and put some benchmarks down. One organisation that has is the European Securities and Markets, Authority. Those guidelines are in your notes. To be honest, if you learn those guidelines, that will give you the basis of an easy discussion question. So I would learn them or learn the key points from them. They all make absolute sense if you look at the words there. So clearly define the alternative performance measure. How do you measure footfall in a store? With financial measures, make sure there's a reconciliation between the alternative measure and a traditional one, like EPS. Here's the earnings, here's the interest, here's the tax, here's the depreciation, here's the amortization. Explain why these things are relevant and explain the extent to which they're reliable. Make sure, and this is important, that alternative measures are not more prominent than traditional measures. So make sure they're not printed in bigger typeface. If you're going to quote it for last year as well. And make sure, of course, you don't keep changing the way in which the alternative performance measure is calculated. To get a better feeling, I would download a set of accounts. I quite like Marks and Spencer's. Again, if you're able to download that, just Google annual report Marks and Spencer's, and excuse me, it's a very clear summary. It's a very clear summary again of what measures they're using, and the language is very friendly to the investors and to us as well.